They lied to you. For years, they told you Bitcoin was digital gold, the future of money, the ultimate safe haven, the one asset that would protect you when everything else collapsed. They put it on billboards. They ran Super Bowl ads for it. They had celebrities, politicians, and billionaires endorsing it on live television. And you believed them. Millions of people believed them. Hedge funds believed them. Pension funds believed them. Even governments started paying attention. But on February 5th, 2026, something happened that shattered that entire narrative. Not slowly, not gradually, in a single day. Bitcoin crashed 15% in 24 hours and fell below $61,000. The token that was supposed to be the safest asset in the digital world experienced its worst single-day decline since the collapse of FTX in November 2022. The same FTX that wiped out billions in savings. The same FTX whose founder is sitting in prison right now. That level of destruction. And while Bitcoin was bleeding, while crypto investors were watching their portfolios evaporate in real time, while $2 billion in leveraged positions were being liquidated across exchanges around the world, gold was sitting at $5,000 an ounce, near its all-time high. Gold had just touched $5,589 on January 28th, a record that nobody, and I mean nobody, thought was possible 2 years ago. When gold was at $2,600, if someone had told you it would reach $5,500 within 12 months, you would have called them insane. But it happened, and it happened while Bitcoin was collapsing. So here's the question nobody in the crypto world wants you to ask. If Bitcoin is digital gold, why did it crash 52% from its October high, while actual gold doubled in value over the same 12 months? That is not a rhetorical question. That is not some talking point from a gold bug. That is the question that breaks the entire argument for Bitcoin as a store of value. And now, even the crypto industry itself is admitting the truth. On February 10th, 2026, Grayscale published a report that said something that would have been unthinkable 2 years ago. Grayscale, not some outsider, not some Bitcoin critic, but one of the largest crypto asset managers on the planet, a company that manages billions of dollars in cryptocurrency. Their head of research, Zach Pandel, wrote that Bitcoin's latest sell-off looks more like a retreat from growth than a crisis of confidence in the network. He said investing in Bitcoin today is fundamentally a bet on adoption, not a bet on safety. Not a bet on preservation, not a bet on protection, a bet on adoption. And until Bitcoin is widely accepted as a global monetary asset, his words, not mine, its price will remain sensitive to risk appetite, rising and falling with growth-oriented portfolios rather than acting as a hedge during market stress. He compared Bitcoin's behavior not to gold, but to high-growth software stocks. When tech stocks sold off, Bitcoin fell in near lockstep. When risk assets declined, Bitcoin declined with them. When fear increased, investors did not run to Bitcoin, they ran from it. That is a direct admission from inside the industry that the digital gold narrative was, at best, premature, and at worst, a marketing story designed to attract your money. Before I go further, if you are the kind of person who actually wants to understand what is happening in financial markets instead of being told what to think, make sure you're subscribed to this channel because what I am about to show you next is the data they do not want you to see. And the Grayscale report went even further. It pointed out that physical gold has surged to record levels while drawing massive inflows at the exact same time that Bitcoin saw capital exit. And that split has weakened the case that Bitcoin reliably holds value during market stress, suggesting that scarcity alone has yet to make it behave like gold when protection matters most. Scarcity alone is not enough. That is a devastating admission from a company whose entire business model depends on people buying crypto. Now, if you're watching this channel, you probably already suspected this, but suspicion is not enough. Let me show you the data, because the numbers tell a story that is impossible to argue with. Over the last 12 months, Bitcoin has lost approximately 40% of its value. Over the same 12 months, gold has gained roughly 74%. That is not a small divergence. That is not a temporary dislocation. That is a complete and total separation of two assets that were marketed as serving the same purpose. One went up 74%, the other went down 40%. Same time period, same global conditions, same geopolitical tensions, same inflation fears, same economic uncertainty, opposite results. By the way, this is exactly the kind of analysis I break down every week on this channel. If you are not subscribed yet, now is a good time, because I am showing you data that most financial channels will not touch. Hit subscribe so you do not miss what comes next. Let me take you through the timeline because the details matter. Bitcoin peaked at $126,000 in early October 2025. At the time, the narrative was unstoppable. Institutional adoption was accelerating. ETFs were buying 46,000 Bitcoin per year. Strategy, formerly known as MicroStrategy, was loading up on hundreds of thousands of coins. Michael Saylor was on every podcast, every conference, every interview, telling the world that Bitcoin was the greatest store of value ever created. He called it digital capital. He called it unbreakable. He said it would outperform every other asset for the next century. And for a brief shining moment in October 2025, at $126,000, it looked like he might be right. But then, slowly at first, then all at once, it unraveled. By late January 2026, Bitcoin had already fallen to 80,000, then 73,000. Then in the first week of February, the floor gave way completely. On Monday, it broke below 73,000. On Tuesday, it hit 72,000. On Wednesday, 72,000 again. And on Thursday, February 5th, it fell off a cliff, 15% in a single day, touching $60,000 and $62 at its lowest point. In a single week, Bitcoin lost 30% of its value. More than $2 billion in leveraged positions were liquidated across all crypto exchanges. The selling was so intense that it became self-reinforcing, each liquidation triggering the next like dominoes falling across the entire crypto market. CoinGlass data shows that on Saturday alone, liquidations across all cryptocurrencies were worth $2.56 billion, making it the 10th biggest single-day liquidation event in crypto history. Ethereum dropped 33% in that same week. Solana hit $88, a two-year low, down 40%. XRP fell 19% in 24 hours. It was not just Bitcoin. The entire crypto ecosystem was collapsing in unison. And where was gold during all of this? Gold was at $5,000 an ounce, setting records, attracting the largest ETF inflows in history. While Bitcoin investors were panicking, gold investors were watching their holdings reach levels that nobody predicted just 18 months earlier. Let me give you some perspective on how dramatic gold's rise has been. Gold started 2025 at around $2,640 per ounce. By April, it had crossed $3,200. By October, it broke $4,300. And by January 28, 2026, it touched $5,589. That is a gain of over 100% in roughly 12 months. Gold, the oldest monetary asset in human history. An asset that has existed for 5,000 years, doubled in a single year. And it was not speculation driving this, it was institutional demand on a scale we have never seen before. Central banks were buying 60 tons per month. That is more than triple the pre-2022 average of 17 tons per month. China's central bank has been buying gold for 15 consecutive months without stopping. India has been increasing reserves. Poland, Turkey, Singapore, all adding to their gold holdings month after month. Global gold ETF inflows in 2025 hit $89 billion. The largest annual inflow ever recorded in the history of gold ETFs. Physical holdings in gold ETFs reached 4,025 tons, an all-time high. The World Gold Council reported that total global gold demand in 2025 rose to 5,002 tons. The total value of that demand was $555 billion. That is not fringe. That is not niche. That is the entire global financial system voting with its money, and it voted for gold. Now, let me show you where the so-called smart money thinks gold is going next, because these numbers matter. JP Morgan is forecasting gold at $6,300 per ounce by the end of 2026. Deutsche Bank says 6,000, UBS says 6,200, Societe Generale says 6,000. Goldman Sachs recently raised their December 2026 target to 5,400. Every major bank on the planet is bullish on gold, not cautiously optimistic, aggressively bullish. JP Morgan expects quarterly investor and central bank demand to average 585 tons, with central banks alone buying around 190 tons per quarter. That is the kind of structural demand that does not disappear overnight. That is not speculation. That is sovereign nations making a deliberate decision to move their reserves into gold. Now compare that to what is happening in the Bitcoin world. The same week, Bitcoin crashed to 60,000. CryptoQuant published data showing that Bitcoin had broken below its 365-day moving average for the first time since March 2022. It had declined 23% in 83 days since the breakdown, and according to CryptoQuant's analysts, that is worse than the early 2022 bear phase, the same period that ended with Bitcoin falling all the way to $16,000. ETFs that were buying 46,000 Bitcoin last year are now net sellers in 2026. Outflows from Bitcoin ETFs totaled $1.7 billion in a single week in late January. Yes, there was a brief reversal last Friday and Monday, $616 million in inflows over 2 days, but that came after weeks of relentless selling, and the overall trend remains negative. Bitcoin ETF assets under management are down. Spot volumes on major exchanges are down 30% since late October. Retail participation is fading, and the fear and greed index hit its lowest level since 2022. But there is something even more revealing in the data that almost nobody is talking about. The basis trade, the strategy where hedge funds buy spot Bitcoin through ETFs and short Bitcoin futures to pocket the difference, used to pay 17% annually with minimal risk. It was the main reason institutional money flowed into Bitcoin ETFs in the first place. By early 2026, that trade was paying less than 5%. The arbitrage opportunity vanished. So hedge funds did what hedge funds always do when the math stops working. They unwound their positions and left. On top of that, stablecoins like Tether and USDC lost nearly $14 billion from December through February. In 1 week alone, $7 billion disappeared. And when investors redeem stablecoins for actual dollars, they are not just repositioning within crypto, they are leaving the ecosystem entirely. And then UBS, one of the most prestigious banks in the world, made a statement that would have been unthinkable 2 years ago. Paul Donovan, their chief economist, said, and I quote, "Crypto is not an asset and is held by a tiny portion of society." Think about that for a moment. A bank that manages trillions of dollars in client wealth just told the world that crypto is not a real asset. Now stop for a moment and think about what I have shown you so far. The largest crypto asset manager says Bitcoin trades like a tech stock. The data shows a 52% crash while gold doubled, ETFs are selling, not buying, retail is fading, volumes are collapsing, and one of the world's most respected banks says crypto is not even a real asset. This is not fear-mongering. This is not conspiracy. This is the data. Every single data point I have given you in this video is verifiable. Every source is in the description below. And if you are serious about understanding where money is actually moving, you need to be here every week. This channel exists to show you what the mainstream financial media either cannot see or will not show you. Subscribe and turn on notifications so the algorithm actually shows you these videos, because YouTube does not push this kind of content unless you tell it to. Now, let me show you something even more revealing. Let me show you what happened to Michael Saylor. Strategy, the company he chairs, reported a $14.2 billion loss in the fourth quarter of 2025. $14.2 billion. Let that number sit with you for a moment. They hold 713,000 Bitcoin at an average cost of $76,052 per coin, and the current price is below their average cost. Their stock fell 17% in a single day and is now down 75% from its peak. The company's market capitalization is now below the value of the Bitcoin it holds, which, in traditional finance, is a signal that the market does not trust the management or the strategy. And here is the part that tells you everything you need to know about where the narrative is heading. On the same earnings call where Saylor reported a $14 billion loss, he announced a new Bitcoin security program to protect Bitcoin from quantum computing. Let me make sure you understand the timing of this. For years, Saylor dismissed quantum computing concerns as, and I will use his exact words, a parade of horrible FUD, fear, uncertainty, and doubt. He told everyone that quantum computing was not a real threat, that Bitcoin was unbreakable, that people who worried about it were spreading misinformation. And then, on the worst earnings call in his company's history, after losing $14 billion in a single quarter, he suddenly reversed course. He announced a global security program to prepare Bitcoin for quantum threats. He said he would coordinate with the global cybersecurity community, the crypto community, and the Bitcoin security community. He said the current consensus is that the quantum threat is at least 10 years away, but that it is, and I quote, reasonable and appropriate for them to lead this effort given their large responsibility as a Bitcoin holder. And during that same call, Bitwise CEO Tom Lee pressed Saylor about quantum vulnerabilities in specific types of wallets, including Satoshi's original wallet, which uses an old pay to public key format, and Taproot wallets, which account for 25 to 30% of all Bitcoin wallets. Saylor had no specific answer. He said it was not appropriate for strategy to advocate for a particular solution or time frame. The man who spent years telling everyone that Bitcoin was the most secure asset ever created could not explain how it would survive a quantum attack on a quarter of all wallets. Now, you can interpret this two ways. Either Saylor genuinely believes in preparing for the future, or a man who just lost $14 billion is looking for a new narrative to keep investors from leaving. I will let you decide which one sounds more likely. But here is what is not debatable. While Saylor was pivoting his narrative, gold was quietly doing exactly what it has always done, preserving wealth. While Bitcoin lost half its value, gold gained 74%. While Bitcoin ETFs saw billions in outflows, gold ETFs saw 89 billion in inflows, the largest year on record. While crypto companies reported historic losses, central banks around the world were buying gold at the fastest rate in modern history, 60 tons per month, 3 times the historical average. China, 15 straight months of purchases, India increasing reserves, Poland, Turkey, Singapore, all adding to their gold holdings. The pattern could not be clearer. Institutions that manage trillions of dollars are choosing gold over Bitcoin when it matters most. Not because they hate technology, not because they do not understand crypto, but because when real money is on the line, when geopolitical tensions rise, when markets fall, they trust what has worked for 5,000 years, not what has worked for 17. And that brings us back to the Grayscale report, because the most important line in that entire report was not about price or charts or technical analysis. It was this: Bitcoin's own long-term test is still unfolding. That is the crypto industry admitting that the experiment is not over, that the outcome is not guaranteed, that everything you have been told about Bitcoin as a store of value is still a theory being tested in real time. Gold is not a theory. Gold is not an experiment. Gold is 5,000 years of proof. Now, I am not telling you to buy or sell anything. That is not what this channel does. What this channel does is show you the data, the real data, the data that most financial media either cannot see or will not show you. And if you have stayed until this point, you understand why this matters? The question is not whether Bitcoin will recover. It might. It has before. The question is whether you are going to keep believing a narrative that even the people selling it are starting to abandon, or whether you're going to look at the data and make your own decision. That is what separates the people who protect their wealth from the people who lose it. Not predictions, not hype, not narratives, data. And here's the thing that should concern every Bitcoin investor the most. The sell-off that just happened was not caused by manipulation. It was not caused by a single event. It was caused by a structural shift in how institutional money views. Bitcoin, the Coinbase premium, was negative for 21 straight days before the crash, meaning Bitcoin was trading cheaper on the main US exchange than on offshore exchanges. That is a signal of sustained American selling pressure. Not panic, not a flash crash. Systematic distribution. Subscribe if you want to keep seeing this kind of analysis. I will be here tomorrow with the latest developments, because this story is far from over.